Today we're going to talk about the top 10 investment and tax mistakes made by new expatriates. I promise you, I'm going to make it short, sweet, and to the point as much as possible, but this will be information heavy today. So, as I always like to tell people that I do meetings with, I will send the slides to you if you would like them. And there is also a version of these slides which contains all of the value added educational content too. I sort of I make them I cut everything down for the purposes of this presentation. I'm going to go ahead and get my screen sharing going here. Let's go, and please let me know if anything from your side is not up to muster. Before we get going, I must tell you, as a disclosure, that none of what we are about to go through constitutes real investment or tax advice, not in the eyes of the law. So, although I hope that this content will be very useful for you in your individual circumstances, if you are a client of ours, then you will receive individualized support in individualized meetings. But the foregoing is going to be for educational purposes, as they say, only. So, who am I? If you are brand new to me, I am John McNertney. I'm a certified financial planner registered with the SEC and with the CFP. Lots of acronyms after my name. I started my own firm a few years ago, primarily to support not just domestic investors, although I have been for almost 20 years working as a registered investment advisor in the United States, but I also work for expatriates now. During the pandemic, I learned a lot about cross-border tax planning, investment planning, and some of these other things we're about to talk about today. There's the rest of my curriculum vitae. You can read it later if you would like. I'm from Iowa/California, and I currently am living in Lisbon, Portugal, and sometimes San Francisco, California. So let's get into the content, shall we? So today we are going to talk about not carrots, but sticks. I have studied human behavior extensively, both during my academic career and as a financial advisor. And the research is clear that carrots are superior. We are at our best when we are seeking some reward that we actually want, and that sticks, supposedly they don't work. But I will tell you, sometimes they do. Sometimes they're highly effective. And when we are afraid of something, I know I've seen some of the people in this room here, we've discussed penalties that can be levied against you if you don't do things right. So that's what we're going to talk about today, talking about not reporting taxes, both in the United States and in Portugal, talking about failures to report on foreign bank accounts and financial accounts, talk about tax treaties, investment choices, neglecting your estate planning. What could that lead to? Ignoring local taxes, currency exchange mistakes, real estate investment errors, and lack of diversification. That's 9 items. I know. There was one more item on this list that I disliked, so I just made the executive decision to cut it out. So anyways, let's jump into it. As always, if you have questions during the presentation, please open up the chat window and type it in, because that will give us more to talk about when I'm done with the 9 mistakes. So mistake number 1, just to start on the most basic level, of course, you've got to do your taxes. It may be a surprise to you that U.S. citizens are always U.S. citizens. Once you are in Estados Unidos, you are always in the Estados Unidos. I think that's how we say it, because Americans is just, well, there's lots of different kinds of Americans. But if you're a U.S. citizen, you will always have a obligation to file your global income. But what do you do from there? You need to ensure that you and your tax planning professional are filing these things correctly. In other words, using the foreign earned income exclusion or the foreign tax credit, right? So these are 2 different ways that you can have your foreign income excluded from your U.S. tax obligations. What's the difference? Well, I'm going to tell you. Difference is that it's earned income versus passive income. So basically, if you have European high European earned income, then you want to use the foreign earned income exclusion. And if you have a lot of passive income, if you're a landlord or you have shares of an investment in Europe, then you're going to use the foreign tax credit. And of course, you're going to want to do your FBAR or your FATCA filing. Why? Well, thank you for asking. Because if we don't, there are consequences. These are the consequences, and they're very, very pernicious. The penalties for late filing in the United States, well, that's not so bad. It's 5% per month of the late amount. So, I mean, $10,000 tax liability that goes unpaid, you are racking up $500 a month. And that maxes out at 25%. Presumably the IRS understands that if you go above that rate, there's a high likelihood that they will have permanent delinquencies. Penalties for non-reporting on the FBAR. This one was the most astonishing to me when I learned of it. The FBAR could cost you up to 50% of the non-reported asset. And this is if you're found to be willfully negligent on the FBAR filings. The U.S. Tax authorities have the ability, and there was actually a client that I was working on with an international estate attorney. The client went to Malaysia, and it did intentionally skirt their FBAR requirements. I don't recall what the purpose was. Probably just some chip on the person's shoulder, but it was a $500,000 mistake. That's right, $1 million in your foreign investment accounts gone unreported. Then you can legally be liable to pay half of that amount to the U.S. government, and then probably forced to come back to the United States, forcibly exported back to the United States and detained. So you don't want to get into this stuff. You do not want to get on the IRS's you-know-what list. The IRS is comprised of individuals too, and sometimes they will have a bone to pick with you if you intentionally are negligent in your tax filing obligations. Also, if you throw up a red flag, the likelihood of being subject to an audit will also go up as well. I'm not going to go through this entire slide. This is why it's valuable for you to ask for the slides later. Here are all the filing deadlines. It's important to recognize that if you have just recently expatriated, April 15th is no longer the relevant date. You have up until June 15th to file your taxes in the United States. So you get an automatic extension to your tax filing deadline. And I always like to advise that you do an extension every year anyways, because if you do an extension on your taxes, and these are pretty much automatically granted, then you will have up until October 15th. October 15th, both to file your taxes as well as to make any retirement account contributions, which might apply to the year in question. The Portuguese deadline, I believe, is the end of June. And so you want to go ahead and file your Portuguese taxes if you're a Portuguese tax resident first, and then you go and you do your U.S. filings later. Just a note at the bottom, if you've been delinquent for years, then you got to get caught up. I did have a client that had this issue this year. He had just neglected to file his tax returns for, I think, about a decade. And he could be forgiven for thinking that now he should just ignore this and just whistle past the graveyard for years. But no, do the streamlined process, get caught up. The IRS is usually pretty forgiving if you find your mistakes before they do. It's just like I do with my children at home. Mistake number 2, misunderstanding your tax treaty. So there is a moment where you and your partner, or just by yourself, will hopefully snuggle up on the couch and spend a night reading the U.S., Portuguese, or if you happen to be in another country, French, U.S., German, U.S. tax treaty. It's pretty important. Why? Well, we'll get to that in just one second. But these treaties exist for a reason. They are there to protect you from being double dipped on taxes. So be aware of the treaty rules regarding the withholding that's going to be automatically calculated against U.S. investments. If you are a non-resident alien, if you're a U.S. citizen, you don't have to worry about getting lumped into the 30% category. Know your specific country's rules, right? There's different countries, and so as I've said, you need to know the rules that are specific to yours, and be aware of the savings clause. There is a savings clause at the bottom of the tax treaty relevant to every country. And the savings clause effectively says this: we are the United States. We are entitled to tax our citizens ultimately on all of the income generated from the U.S., period. But if you're going to take that position, you will always have to litigate it. So just be aware of that. And then familiarize yourself with mutual agreement procedures. This is an IRS guideline where this is basically how you litigate the savings clause or any treaty position in case you have to. So what are consequences for not knowing the tax treaties? It's boring, right? But these two guys, love this image. They're taking it on the chin because they were not aware. So you could overpay on your taxes. I imagine that these people exist. I haven't met them that just blissfully ignore all of the tax treaty and pay their taxes on their global income in both countries. That might happen if you don't file your taxes correctly. There's missed opportunities for tax planning. Understanding the treaty and how it interacts with your taxes. It's my job, right? We can figure out how to sort of stage your income taxes if we have control over recognition of taxes so that you can sort of spread things out in a way that makes the most sense. You want to be compliant again. Being on the radar of the IRS again can raise those red flags on your profile, potentially leading to audits or investigations. And in the end, why take the risk of not knowing? The document itself is really only about 5 pages long. So again, be these guys, snuggled up on the couch. Honey, let's read the tax treaty tonight. Okay. And again, if you get the slides from me, I provided some additional information on understanding tax treaties. Item number 3. I guess I mislabeled them, but this is mistake number 3. Mistake number 4: inappropriate investment choices. Okay, now we're talking about international investment choices. And first on the list, gonna have to say real estate. I hope that the clients that that really love these expensive new properties that they're buying are not in the audience right now, because location, location, location. Like, do you have in-depth knowledge of the local market? Do you really? Local markets can have unique dynamics. They have different regulations sometimes, and there are different risks that might exist with regards to your new property. If you want to become an employer, how well do you understand labor law? Here in Portugal, I have been sued by an employee. I frankly made this mistake myself. I didn't understand the social security system in Portugal, and then I was sued by that employee, quite rightfully, and it was expensive, both in time and in emotional angst, as I felt like a bad person for a minute. So don't be that person. Do you want to be a landlord? How about it? Being a landlord almost always opens you up to some new and significant liabilities. And here in Portugal, do you understand the rental laws? Because the rental laws do tend to be pretty favorable to tenants in Portugal. I've heard horror stories of squatters staying in properties up to 2 years without paying. It's horrifying. And so, caveat emptor. Are you going to be a business owner? How well do you understand labor law, environmental regulations? There was a situation that I was attached to where a U.S. employer wasn't aware that their Portuguese-based workers had a variety of different rights. I mean, as Americans, we think of Europeans and their work habits, and we automatically think, they don't work as hard as we do. maybe a little bit of truth to that, and they may be proud of the fact that they take all of the public holidays and they are entitled to pretty much the month of December and parts of summer just off. You can't force them to work by law outside of regular business hours. Political and economic instability. Now, this one's funny because Portugal is actually historically a pretty serene place. It's considered quite stable, but it's not without its issues. Number one, slow economic growth. I mean, people that are buying properties in Portugal right now, folks, I'm not sure that Portugal has the growth trajectory that you're used to. If you lived in, I don't know, Columbus, Ohio, over the last 5 years, or parts of California, of course. I don't think you're going to see that here in Europe on the real estate or on the business front. Portugal depends on external factors. Historically, it's depended on tourism and exports to major European markets. And so, in the event of a downturn, either in tourism, think the pandemic, or in exports, Portugal it has a lot of Achilles heels, and so that could be a challenge to you and to your investment if you choose to go that route. All right. Examples of inappropriate investments. As I said, there was a booming real estate bonanza going on. Right. Like, who wants to buy in the middle of any bonanza? I know you know the answer to that. Complex financial products. There's going to be a bevy of new financial products that you may have access to. Don't take the bait. The U.S. is still among one of the most vibrant and growth-oriented markets in the world. I had a fellow tell me that he came across a British investment advisor that explained the benefits of putting all of your assets into a wrapper, sir, to avoid taxes, sir. Didn't really work out quite like that because the wrapper product was a British product and it didn't extend the same tax benefits to the U.S. person at all, and the person did not go through with it. This was a friend actually who brought the wrapper concept to me, but he had a twinkle in his eye that presumably he had gotten from that British tax advisor. Don't just talk with your friends, talk with me, talk with somebody that knows. Alternative investments without clear earnings. Cryptocurrencies, a lot of fun, lots and lots of fun. And there could philosophically be a point to cryptocurrencies. I'm not saying that it's entirely half-baked, but have you bought a pizza with a crypto dollar recently? I don't know many people that have, although the first actually Bitcoin that was invented was used to buy pizza. But recently, no, I don't think that crypto really is a alternative investment with a clear earnings path. And then non-diversified portfolios, which I'm going to get into in just a little bit. Who does not love all of the amazing tech stocks that have been going to the moon lately? But you've got to have a balanced diet. You've got to have a balanced investment portfolio. It might not be fun, but there's consequences to not doing this. So, smart investment strategies for expats. Just understand stuff. Once again, it's not crazy. Understand your local and your home country tax implications. The understanding here is crucial to avoiding double taxation and to making the most of the tax advantages available to expats. Diversify your investments, manage currency risks. And when I think of currency risks, I think that the best way to solve for that is just having an emergency fund so you don't have to worry about taking money on any given day and being at the mercy of the current exchange rates. And always seek investments that are suited to your longer term plans. Asterisk, talk to your local investment advisor. If you don't have one, then let one audition for the role. Some additional resources. Check these out later as well. Neglecting estate planning. I should say, this mistake is going to get you if you don't do it in the United States as well. But neglecting estate planning in Portuguese could be even more painful. Number one, the complexity of international laws. Recognize the similarities and the differences between the two laws, the legal environments. I had a client who went to a country that had Sharia law. Okay, you want to talk about a philosophically different approach to who gets mom and dad's assets. You go to a country that is overseen by Sharia law. Um, you want to recognize the differences. Just again, this is just basic basic awareness. Protecting assets across borders. Does your existing trust or your will or your pension, does it cover you everywhere? What happens if it doesn't? We'll talk about that in just a second. And then ensure dependents' financial security. That is essentially going to be the same as protecting your assets. Is even more importantly, protect your family, right? And so the consequences. This image I found just it does send shivers down my spine of leaving your child in an unfamiliar country without having taken the proper measures to ensure that that they'll be taken care of if things don't work well. So legal complications and disputes, the consequences of not having a will here. Can you imagine being in a country like Portugal and having to probate your assets in that country? Probate meaning if you die unexpectedly, your assets are going to need to be split up by the government and the system in which you live. So, your financial assets, if they're back in the United States, probably they're just fine. But if you buy a house in Portugal or anywhere abroad, you're going to have to probate that asset in that country unless you have a will that points back to the trust planning that you've probably done back in the United States. So you want to avoid that, of course. There's a potential for unintended tax consequences, both in your home country as well as abroad. For instance, failing to understand the domiciliary rules can result in unexpected inheritance tax liabilities here. So if your assets are domiciled here, then you're going to have to deal with the stamp tax for transferring the ownership of those assets. And then, of course, just failing to have a plan and leaving your child in a state of certainty. Life insurance policies, wills, etc., that you've done in the United States might not be considered valid in your new country of residence. So, what do we do? Well, here's the resources. What it basically comes down to is just do your homework first, and second, you do have to get a professional in most cases so that they can design at least a basic will to extend the protections that are necessary to your loved ones or to whomever is going to inherit your assets. Number 6. I already talked about this, didn't I? Ignoring local taxes. I ignored blissfully some local Social Security dues that were required. So don't ignore the local taxes. The concept of tax residency is determined by what? By the amount of time spent in a country where you are going to be living. So if you live in Portugal for 183 days, on day 183 of any given year, or in a rolling 183 days, I should say, that's when you become a tax resident, whether you want to be a tax resident or not. If you want to be a tax resident, on the other hand, you can become a tax resident the minute that you want to if you live here and you change your residence to here. The status affects your tax obligations and whether you're liable to pay taxes on worldwide income in that country. And don't think that you can get away with not reporting your US based income when you live in Portugal. It is a requirement, unfortunately. So don't underestimate their IRS here. Familiarity with local tax laws. What do you know about the local taxes? And do you have a working familiarity with Social Security? I brought this up twice, so I won't harp on my woeful story. But really, like you do have to pay Social Security for a company if you own a company here, as well as a number of different kinds of taxes you may not be familiar with in the United States. I'm also thinking of some deductions you might miss out on if you're not paying close attention to how to take deductions on a Portuguese company. So pay attention. It could be worth a lot of money because you don't want to see penalidades. Penalidades. Risks associated with non-compliance here can also be brutal. They're, to be fair, they're less frequently applied. It's worth pointing out that the Portuguese authorities have a little bit less efficiency, is my understanding, than the U.S. Tax authorities, but you'll still face some stiff punishments if you're caught on these issues. Criminal proceedings, fines, penalties. Do you want to be prosecuted for tax evasion in a foreign country? I thought not. Impact on financial services access. And guys, this is the worst, not being able to access mortgages in Portugal because the rates are so good. They just are now boom. And if you're found to be, again, willfully negligent, then you may be denied access to the financial services markets. You gotta mind your P's and Q's. And damage to your privacy. Audits is what I'm thinking. Once again, we talked about this in the U.S. It happens here too. If you're found to be engaging in some no good activities, you could be flagged for an audit, and those conversations are just never fun. Navigating local tax systems. So again, each country has its own criteria for defining tax residency. Figure out what your target country's rules are. In Portugal, it's 183 days. Just get educated. Keep track of your income sources. If you have multiple income sources from multiple countries, get a bookkeeper, okay? Or get good at QuickBooks. Stay updated on tax laws and changes. This is just as simple as finding one of the many great expat news sources that regularly provide updates to us. Or if you work with me, or you would like to work with me, I provide updates on changes to tax law as they become relevant as well. And take advantage of those benefits because there are tax benefits to be had here. Housing, education, a variety of other expenses are deductible in ways that they may not be in your home country. And so research these benefits and, if necessary, consult with a tax professional to ensure that you know what you're doing and that you're compliant. Be good. Yeah, these are some good things to think about. Okay. I mean, again, not my favorite thing to think about, taxes, but I've already said seek a professional and locate people with the right credentials. What are the right credentials? Two different types of tax professionals, tax lawyers, and the other type, contabilistas. It's important to note that in Portugal, you don't use a CPA. The CPA, in the United States, you have a CPA that covers you on both fronts. Here, you want to have a contabilista primarily because they're going to help you to file your taxes every year. How do you find those people? It's all about communication. Never be afraid to ask. And especially when you're in Portugal, don't be afraid to ask, okay? Because I have found that culturally, they are even less inclined to be forthcoming with information that you need. So you must ask. And if you don't get the right answer, then either that indicates a lack of willingness on the participants to be really forthcoming with you. Trust your gut. Just move along. Never be afraid to just move on if you don't get the advice that you feel is appropriate. Mistake number 8, currencies. This is an interesting one because it's only kind of manageable. So with the impact of currency fluctuations, you're going to feel that impact keenly if you don't have a buffer. So we talked about this before. Have a what do you call it? Emergency fund, and have 6 months of living expenses at least saved up in euros. That way, you can prevent yourself from having to take whatever conversion rate that is available on any given day. With real world assets like properties, cars, other big ticket items, just get that purchase as soon as you can. And then, as I say here, then chill and don't worry because there's not really much to do. But definitely get that sort of like that layer needs to be salted in and done so that you can avoid being prey to currency risk. Pension value fluctuations. This is just for the English people for the most part. And this is just to say, I'm sorry. I'm sorry that your country made it so hard for you and for your pounds sterling. If you have a pension, you are going to have to be prey, and Social Security counts too, is your prey to the currency fluctuations. There's really no way to get around that. Common mistakes. Common mistakes really just boils down to a few things. Not understanding hedging. And I mean hedging in the sense that I just mentioned, which is build up a shield wall of cash in euros. But then also understand how to do currency hedging. How do you do it? Well, you need to use currency trading specialists. I'm thinking of the guys over at Spartan FX have been really good at doing this for some of my clients. But it's not without its problems either. There's a small cost, of course, it's associated with doing currency hedging. Uh, Inadequate planning. That's again basic. Just build that buffer, the 6 months in cash into your planning. And for the most part, ignore macroeconomics. I love to study macroeconomics every day, but it will just drive you crazy. So if you look at the rate of change in the US dollar versus euro relationship, that currency pair has basically stayed in kind of a channel. It's been in contango, is what they call it in trading, for about 20 years. So don't get too hung up on it. If you can help it, because looking at the market every day is a bit like watching a pot boil. It's going to boil whether you look at it or not. Mismanagement of international transfers. So just use the right tool for the job. Do you want to use Wise? Do you want to use Revolut? Do you want to use your bank? It's fine. But each of them has sort of different timing and different costs that are associated with them. So think about those things and be clear about them um, because there's a tool for every job. Real estate. I really love real estate. I wish the realtors that I met didn't think that I was trying to work at odds with them, because everybody should have an opportunity to own what they live in. Mas é difícil aqui em Portugal, porque os donos são diferentes. It's all about location here too. But there are some specific pitfalls. There's some specific issues that you need to be aware of. There was the Spain and Cypriot crises that happened about a decade ago. If you really want to read the stuff of nightmares, Google this later. And it can happen in Portugal too, unfortunately. When there's a title transfer, there can still be at times a loan attached to the title that can transfer with the title. And so, unbeknownst to you, if you don't do all of your homework, down in the sort of fine print that shows you, what's associated with the property, there can sometimes be liens, tax liens, loans that are associated with the property that you can assume if you purchase the property without looking into it. Those Spain and Cyprus stories, those involve international investors that bought properties in Spain and in Cyprus sight unseen. If you can imagine. Again, I don't know these people that do this, but they probably wanted to become residents. That was a path to doing so, and they basically never got their properties because the properties were unwarranted. Tax pitfalls, stamp duties on purchase, there's income tax on rental profits, capital gains. These are all things that are real and that you should just know about going into any purchase of a property. Political and economic instability, we've seen it in the last 6 months, haven't we? When the government shut down the NHR program, very shortly after having shut down the Golden Visa program for the purchases of property. What can we say? Portugal is a very small country, and so the attention that has been heaped upon it by more well-heeled countries in the last 5 years have driven up property prices, and I do expect to see that come back down. We're already seeing some softening in the Portuguese property market this year, probably as a result of the cancellation of the NHR. which is what they wanted. But watch out for that. I mean, if you want to buy right now, be my guest. But I would say watch the property market closely. If you can be patient, prices may come back down. And then the laws and regulations governing real estate here are pretty different. It's essential to be aware of those details to ensure that your investments are secure. Legal and financial considerations. Not much to be said here, other than the fact that there are implications associated with making investments in Portugal, especially if you're buying a non-real estate investment that produces income. That's going to result in a dreaded tax that's called the PFIC tax. Please see me offline or ask me for the gory details. Oh, phone is ringing. Ask me for the gory details later if you'd like. And mistake number 10, well, it's actually mistake number 9, isn't it? But this is a lack of diversification. I find this to happen almost at all times. Huh. Well, this happens even domestically, and this is a pretty obvious and clear issue here. This is making investments in a single asset, either in your portfolio or in your in your real estate portfolio, and this exposes you to the same issue always, which is that issue that stock could get hit hard, or that real estate market could drop suddenly, and that could leave you with a loss of value. And so the importance of diversification can be explored in the context of a well done financial plan. That's where I spend the majority of my time. And you can, you can diversify by purchasing a good mix of non-correlated assets. So for every, Apple stock, maybe you buy a little Procter and Gamble. You mix things up. So diversifying your investment portfolio can be done easily. Let's take one of these case studies. So I always design these case studies but feel like they're a bit too pedantic to share with you guys. But let's talk about it. So I have actually met some people that have overlooked the NHR status. Why is that important? Well, I mean, if you know what the non-habitual residency status is, you understand that it can reduce your income tax rates down to a ceiling of about 20%. It gives you tax exemptions on foreign source income, and it gives you a flat 10% tax on foreign pensions. Why is that important? Well, since you asked, I'll tell you. It's because passive income from real estate abroad, or income from any source that is paying you abroad, all of these things will be taxed at Portuguese tax rates if you don't sign up for the NHR and you're qualified for it. There is a new form of NHR that's just come to market this year, voted in last week, which will do this as well. But if you don't register for this and you are indeed receiving income from anything abroad, then that is just lost money. You're leaving it on the table. And so that is a mistake that I have seen some individuals make. Not very many, but it happens. What else? Well, we have a few different mistakes, and I'm just going to leave for you if you would like to download this file for me later, because I'm at about 30 minutes now, which is where I wanted to be. So the takeaways from what we're doing here, I think, can be explained in what I always talk about, which is the financial planning process. You can benefit yourself greatly by looking before you leap. And that's what I do when I help folks with financial planning. So in the pre-move phase, you want to identify all of these types of issues that could be hitting you. When you move, after you've moved, you want to make sure that you have reestablished your base camp here with all of these things well thought through. So, understand your global tax circumstances, understand whether your retirement savings are in the right kinds of accounts, and whether you'll continue to receive benefits from making those contributions to your retirement accounts. All across the board, make sure that you are smart about this. And then as you move forward, you just integrate everything together. I see a few people in the room here that work with me now, we're going to be, as we move through this year, we're going to be continuing to work on that tapestry, weaving your two tax identities together so that you can be independent as you go about the rest of your life. So that guys, that's that. So I'm going to open it up for questions and answers. If you have them, I'm going to turn the screen share off because we don't need to look at an empty screen unless there's things on the screen that I do need to address. So I'm going to open up the chat here. I'm going to show the chat window, and you don't need to raise your hand. You can just throw some questions into the chat if you have them. And if you don't, well, then we can get the rest of our day back here. Okay. Q&A. We've got some people saying hello. Hello. Good to see you. This was a wonky presentation tonight, I will admit. So if you don't have questions or you'd like to email me later, then that's totally cool. Do you need to pay Social Security in the U.S. or in Portugal? That is a question. That is a great question, actually. So I'm going to go ahead and answer that. The answer is you're going to be paying those once you become a Portuguese tax resident to the Portuguese tax authorities. So there is going to be a little bit of withholding on your Social Security, but you are going to be paying at a maximum of 20% on your U.S. pensions to the Portuguese tax authorities. Getting some attaboys. Thanks, Jeff. I appreciate that. Best way to screen for a tax accountant? Awesome question. Okay, I am actually hiring right now, and I'm going to take the same approach to hiring people that I take to hiring accountants, which is they should be ready to take the hard questions right away. So you should be prepared. They should be prepared to be interviewed and answer questions just as if they were in the middle of doing the work for you. If they want a fee up front, that's a non-starter for me. I take 15-minute interviews with people that might want to hire me so that they can sample how I think. So I've had the same issues with accountants. The good ones will talk to you just a little bit before they expect to be paid. Hopefully that helps, Devin. I was just trying to get your okay. Can you explain Step Up and what investments it might affect? William, awesome question. So for a number of years, I worked at a brokerage firm called TD Ameritrade, and I had to do the Step Up in basis. So what that means is when you die, your assets are distributed to whomever you have elected to distribute them to. But if you purchase them at a certain value and your loved ones had to sell them with that value embedded so that they had to calculate capital gains, that could be disastrous. So you bought a house for 100 grand, it's now worth $1 million when you die. You don't want your kids to have to pay on $900,000 in capital gains. So the step up is this you take the asset and you step up the taxable basis upon which they calculate the gains to whatever today's market value is. So you pass away and that house is worth $1 million. You're not going to pay any gains on it because the value's been stepped up. And that principle applies to all of your investments as well. Paper assets, bonds, you name it. Okay. It's just you have to sort of be really cognizant of the reporting entity. So for stocks, that's why when I worked at TD Ameritrade, you have to give the death certificate to them and make sure that they step up the basis where that basis is recorded. Hopefully that helps. We're new expats for NHR. Is there reason to keep our address with the U.S. IRS with our U.S. address? So I have a question here on whether it makes sense to keep your address with the U.S. IRS. Let's see. Why would you want to keep your address? I mean, that's a good question, Doug. A lot of people do keep their U.S. address for the purposes of, like their custodian, for example. If you have a Fidelity account, once you tell them you're a Portuguese resident, then they might take some rather unpleasant decisions against you with your accounts. But with the IRS, it always pays to be honest, to be 100% honest with the IRS. After all, you're going to be filing taxes with them every year until you die, and so you want them to know what your status is by default, rather than be unclear on anything. I can't think of a lot of advantages to trying to keep your uh, to keeping your tax residence secret. We have an individual who is going to be bringing a business here. So I have a question from William. His wife's business may be considered a Portuguese entity. If so, would that mean that she needs to pay Portuguese and U.S. Social Security taxes? That is an interesting question. So that's a question of whether your Social Security dues are going to be affected or are going to be effectively rendered in both countries. And that actually is a no. And I'll tell you why. There is an issue that's known as what's it called? It's escaping me right now. But the Social Security Administration in the U.S. has actually planned for this, and so they do have it's called the totalization agreement. So there is another sub-treaty called the totalization agreement that exists between these two countries, and the totalization agreement works the same way that the dual tax agreement does, which is it sort of like figures out where the Social Security dues are to be rendered, and it effectively makes a payment back to the home country so that you're paying for U.S. Social Security as well. So you could theoretically move to Portugal with only 30 of your 40 required credits, and you could continue actually getting credits towards your U.S. Ultimate Social Security. So the answer is yes. You're going to be paying to is no. You're going to be paying to one or the other, but you're going to continue getting credits for your Social Security. Okay. Wow, you guys are lively tonight. Oh, we got a question from Devin. Is it still true that Charles Schwab is okay with foreign residents? Um, is it okay with any others? Devin asks for any others. Well, I'll take two variations on how that question could be taken. Charles Schwab is okay with you living in Portugal, and there are other jurisdictions, tax jurisdictions, that they are also comfortable with in Europe. So they're comfortable with the Netherlands. I just checked that out for somebody. They're comfortable with Spain. They're not at all comfortable with France. They're not at all comfortable with Italy. So there is a sort of fluctuating list of countries whose tax regimes the U.S. or the custodians are comfortable with. And so in my case, I have Charles Schwab, and then I have a couple of backups in addition, because as I've said, that go no go list can be subject to fluctuations, and so you have to always sort of wear a belt and a pair of suspenders is my attitude. Yeah, William, you're welcome for the totalization agreement piece. Look that up online. It's a very important concept. Ray asks, are U.S. state taxes a concern under the tax treaty, or is it only federal tax? A concern. Well, that's a darn good question that I don't know the answer to, actually. So I think the question that Ray is asking is, would you, if you're going to be assessed state taxes on an ongoing basis after you move to Portugal, would you receive a tax credit in Portugal? And the answer, I would think, is yes. Okay, and that's just me thinking on my feet. But if we think about the concept of how the tax treaty works for both countries, is they're essentially looking to see whether you have a tax obligation that's been paid in the other country. And so the state taxes would probably rack up. I'm almost 99% sure that they would rack up against your Portuguese tax liabilities. Okay. I'm going to keep taking questions, so please feel free to leave, rather, if you want to, but I want to sort of reward the really thought-provoking questions we're getting. Hi, John. I bought a property in Porto last year, which is an off-plan and is being built and deed ready first quarter of 2025. Parabéns. I'm 61. Should I apply for my D7 visa this year since I'm still qualified for NHR, as I did my promissory note in 2023 before the October 10th deadline? Of course, my problem is I can't just move for 183 days a year because of my daughter and my wife. So the question is, should I apply for my visa this year? So you have a property here. That's a good question. So the question that Eddie's asking is, should he apply for the D7 visa? And because he's qualified for NHR, should he become a tax resident? Is, I think, the implied question. Yes, if you can. I would seek further clarification from an attorney on this point, because my understanding is you must have a Portuguese residence in order to apply to be a Portuguese tax resident. Yeah, and so because it's a mechanics issue, okay, on the finances website, you will not be allowed to request for your NHR. You won't be allowed to click on that if you don't have Portuguese tax residency. So you've got to do that. Yeah, Devin agrees. Yeah, you don't need to be in the country for 183 days to have to be granted NHR. He's in the same situation. So yeah, so you probably just have to apply outside of the normal mechanical process on finances. So great question, guys, and great sort of helping each other answer that question as well. Okay, I think we're done. Questions have tapered off. I think we're done. Pronto. Okay. Well, as always, can you advise on UK Portuguese tax planning if I'm no longer a U.S. citizen? Absolutely. Yeah, I can advise on UK and Portuguese tax planning. But as a certified financial planner, I will always make you fully aware of the limits of my actual technical knowledge. I must do that. But I have pretty good technical knowledge in a variety of things. So reach out to me if you want to engage me and talk more. But other than that, I think I'm going to go. As always, guys, it is just a real delight to be able to do what I do. It is kind of it's a dream, and it's coming true all the time. I have to tear myself away from my work some days. Yeah, let me know if you have additional questions. William, I'm going to shut the seminar down right now, but just email me the question that you just had, and we'll talk further. Other than that, até breve, be well, and I'll talk to you next time.